Are you chasing performance? For the past 130 years, human nature has remained unchanged. Miss Greed asks, I want to earn 40%, and my friend made 100% last year, Mr. Fear replies, can you accept a 40% loss? Will your friend still make 100% this year? Or has luck run out? The moment you ask such questions, experts can already tell whether you're just smart or truly wise. Performance and risk are like the two wings of a plane, or like your shadow. They can never be separated. Ignoring risk is like flying with just one wing. Can you imagine the crash? According to Morningstar, which has evaluated 50,000 funds over 40 years across 18 types, as shown in the chart, which type of performance are you referring to? Morningstar discovered the winner's curse. The top performing funds have a 70% chance of falling out of the top quartile the next year. There's a clear reason for this, astonishing but true. Traditional performance is about the rearview mirror, advanced performance is about the telescope. Rearview mirror. Past performance does not predict the future and may even mislead because it lacks forward-looking projections. Case 1. In 2020, ARKK, a tech fund, returned 68%, becoming the top-performing technology fund in the US. However, in 2021, its return fell to -3.4%, placing it at the bottom. 2 years later, its price dropped from $156 to $31, a loss of over 80%. Case 2, LTCM, Long-Term Capital Management, founded by Nobel laureates and elite economists, collapsed in 1998 after the Russian debt default despite its shining performance and reputation. Case 3, the quant quake of 2007. Many quant funds collapsed due to correlated strategies triggering a chain reaction. Chasing performance is like a moth chasing a flame, countless casualties. This has happened for 130 years and will never stop. That's why sustained stable performance is the dream of every investor. Investors like Warren Buffett and James Simons have steady personalities and have achieved more than 20 years of consistent results. The stark contrast between crashing down and steadily building wealth might be a decision worth your consideration. The telescope focuses on future performance, and that requires a predictive model. A US president once said, "The best definition of intelligence is prediction." Forecasting must include luck. We classify it into three main components: compatibility, forecast curve, asset allocation. These three elements form the core of our investment navigation system. Mutual funds are like public buses, other funds are more like Uber rides. But AIA's navigation system is your private jet, equipped with advanced models that forecast luck. When you combine high predictability, resilience, and transparency, the difference becomes clear and substantial. Since many people are puzzled by luck, let us explain further. Luck, like when Trump dodged an assassination attempt, is the ultimate case. Even billionaires and Fed chairs publicly acknowledge the power of luck. It's unpredictable and uncontrollable, covering things you can't foresee, and it's everywhere: elections, investments, and daily life. Like a shadow or Wi-Fi signal, it follows you everywhere. Even life and death are tied to it. Risk and emotion are forms of luck, a profound yet often misunderstood force. Example: if you sit next to a baby or a beautiful woman on a plane, it affects your sleep. Even seat selection is a form of luck. Luck doesn't care about your age, gender, or status. Accurately modeling it would demand technology beyond today's 2 nanometers chips, capabilities that remain out of reach even for advanced AI. One of AIA's core values is helping investors identify both the level of risk and the strength of luck. Using phase strategies, we help achieve appropriate performance because long-term returns vary by person. Quarterly or occasional reviews outperform Wall Street's outdated 50-year-old surveys and your own gut feelings, because risk isn't a straight line. The telescope is used to see the future. For example, on January 6, 2025, we publicly advised in x.com/AIA index. Sell everything before February 27th. That was a wise and proven move. We also saw that some should increase positions on April 8th. They became the lucky ones. Others, distracted by emotions, missed the opportunity. In just 2 months, the performance gap reached 50%. Emotions and luck became decisive factors. A client's performance chart also showed market conditions, emotional resilience, good luck. These three elements aligned perfectly. Performance and risk table. performance and risk can be measured quarterly. With enough protection, AIA emphasizes, performance and risk are like flight instruments. Stability is key to flying far and enjoying the journey. We classify performance and risk into 5 levels. First, determine your risk tolerance. It's a wise first step. Examples. If you pick level 1, conservative, we'll remind you when it's time to be aggressive. If you pick level 5, radical, we'll recommend waiting for the right time to reduce risk and naturally improve performance. We give each strategy a validity period, which varies by person, portfolio size, and timing. Break free from rigid thinking. It's not guaranteed to be perfect, but it may be your best choice. In an era of AI competition, information advantages are disappearing. One person can go fast, but a group can go far. Trust and performance. We quote Howard Marks, founder of Oaktree Capital. All your knowledge is about the past. All your decisions are about the future. Howard's subscribers are mostly top-tier investors. In a competitive market where everyone's skills are similar, patience and luck become the key differences. We welcome blind tests of your past surprises and invite you to share in the joy of our forecasts. See x.com/AIA index. We use expensive models and tools to deliver insights. Once you choose your risk level, we support you in tough times, bad luck. We boost your success in good times, good luck. Our commitment to long-term results is built on a proven judgment model, not short-term market noise. We completely ease the anxiety caused by daily market fluctuations, helping you sleep better and stay healthy. Because life matters more than wealth. The more you let go, the more relaxed you become. The more your long-term performance will shine. The more you relax, the more you earn. We welcome your questions. Thank you for watching and participating. We wish you good luck because you deserve it.